Well, stocks may have rallied this week, but gold sure didn't. Today, it did add 31 cents to finish at $1,244 an ounce, but its weekly decline was 3.7%, worst in 2 months. And on Wednesday, it touched its lowest level since summer. All this comes amid a flourishing debate now about whether investors should continue to invest in the precious metal at all. Just this week, analysts at Goldman Sachs predicted a significant decline in gold prices next year. But David Einhorn, founder of the hedge fund Greenlight Capital, says it's still a good idea to keep gold in your portfolio.
What we really own gold for is just in case something goes really haywire. And what I'm thinking about it in terms of is mostly the monetary policies, but also the fiscal policies that are being run by the big economies.
Well, gold prices have fallen around 26% so far this year.
So, should you follow David Einhorn and buy some gold for your portfolio? Our next two guests have different answers to that question. Suki Cooper says no. She's precious metals analyst at Barclays. And Alex Merck is more bullish, predicting gold prices will get up to $1,500 an ounce over the next year. He's president and chief investment officer of Merck Investments. Welcome to both of you. Suki, let me begin with you. Make the case why you think investors shouldn't put gold in their portfolios.
If we look at the two key factors that have been driving gold so far this year, on the one hand, it's been investment demand, and we've seen sizable disinvestment, whether it's exchange-traded products or whether it's in the futures market. And that's been because investors have been attracted to other assets. And on the second factor, it's the physical market. And although we saw strong buying from China and India when we saw the price correction in April and June, now we're in the middle of a seasonally strong period for demand, and we haven't seen that same level of activity coming through from India or from China, which should start to pick up before the Chinese New Year. So these two key factors here are lending very little support to gold. And furthermore, gold has had a number of positive factors to push prices higher so far this year, and prices have sidelined those factors entirely. So we think the risks to gold are actually skewed to the downside.
All right, Axel, Suki says the risks are to the downside, which doesn't necessarily mean that you shouldn't hold some gold for the long term. Make the case for it. We've got lots of debt all around the world. We've got currencies that people question, but there is no inflation right now.
Well, the biggest risk, I think, that's out there, if you look at market sensitivity, is economic growth. And the reason I say that is that bonds are bound to plunge if we get economic growth. We cannot afford positive real interest rates. We could pay $1 trillion more a year and 10 years down the road on serving government debt if we go back to historic levels of interest rates. We can't afford that, so we have to err on the side of inflation. The Fed has said they're going to err on the side of inflation, want to have full employment. And so I think gold is a very good hedge and diversifier. You want something that goes down in an up market, and you want to have something that everybody is hating. And so, yes, the trend has been downward, but when the S&P goes up in a straight line, I think I would want to take some chips off the table, and gold is much cheaper than it has been.
Well, Axel, you're basically making the case that gold is a safe haven investment. So, Suki, let me ask you that. I mean, even David Einhorn is saying that he's owning it because just in case things really go haywire. So are you saying that gold doesn't really serve this safe haven status anymore?
Previously, we saw gold was quite a good hedge for the financial uncertainty, whether it was credit market uncertainty or whether it was counterparty risk. That was an environment where gold actually flourished. But right now, this year, we've seen geopolitical tensions rising and gold rallied a little bit. But we've had so many other factors where gold should have done well, such as during the US government shutdown, yet prices actually fell. Some investors are actually looking elsewhere to perhaps the currencies for a safe haven bet, rather than actually looking to gold as a safe haven hedge.
You know, Axel, let's say I'm persuaded by your argument here. If so, how much gold should I hold in my portfolio? How much do you have in your own portfolio? That might be a different way of asking it. And in what form should I buy it?
Well, sure. Gold is a risky asset, so with any asset, one has to think about what one can stomach. In our hard currency fund, we have about 13%. I personally have substantially more, simply because I like the diversification. I am scared when there's complacency, a low VIX index, the S&P goes to new highs, when bonds are expensive. And so, yes, by all means, gold has come down, but it's just making it better and better value. And so I have a substantial portion of my own net worth in gold, and others, they have to decide for themselves. But clearly, if you just think you're going to chase the markets because it's doing well and you're selling gold because it's doing poorly, I think that's the very wrong way to look at it.
Before we say goodbye to both of you, so Axel, would you own the metal or the stock, or how would you fill your portfolio?
I prefer the reduced volatility of the metal, but clearly, if you think gold is going to go higher, odds are that the mining companies, with all the focus they have on profits, might be doing better. But still, I think we're going to have volatile periods, and as such, the low volatility, for me personally, I prefer on the metal.
Okay, all right. Thank you both very, very much. Suki Cooper, precious metals analyst at Barclays, and Axel Merk, he's president and chief investment officer of Merk Investments.